Okay, gang, I want to show you something if in a chart. If you recall, the I said in the last month of June, the last week of June, when we had the historic dump of stocks, like we never had. Institution dumped more stocks than ever before in history the last week of June of 2015, and I said that was the beginning of our stock market crash. Crashes take a very long time, okay, to happen. But they have a starting point, and that was our starting point. And let me explain why. I was right. Okay, if we go back and we look at the New York Stock Exchange, okay, I'll represent this as the New York Stock Exchange, New York stock market. If we go back and we take a look how many times this market could not break out, we go and we look, and it was July. Let me show you. July was the first time it ran, and she couldn't break out in July. Then she couldn't break out in September. Had a problem breaking out in September. Then she had another problem when we got into December. Okay, and then finally, it was February of this year here. 4 times we could not break out. But the problem was, the reason why we couldn't break out is because we had more stocks going down than up. It was the breadth. And as we had more stocks on the New York Stock Exchange going down, okay, than making new highs. All right, that's the problem. And because we had more stocks going down than going up, it prevented us from breaking out. So it was very clear the market was in trouble, okay, at that point. Now, if we go and we move forward a little bit and see where we are today, let me move this over. We have another problem. Remember, that was February, okay? That was February. So let's move this over. All right, let me move this up a little bit. Okay, that was February. All right. Now, as we had this little correction right here where this pulled back, and we had this big move. Then all of a sudden we went sideways again on the S&P. Then we had this, but remember when this was going up, and this now I'm moving from, this was just at the end of February here. Now this was March. I'm thinking of February to March now. Now we're in March. Okay, here's February right here. That was the finish of February. We dropped in March. All right, and then we had this rally, and we had this nice move right here. And what's nice about that, it means you have a consensus. That means everybody agrees the market's doing well, the earnings are good, everybody's happy. But then it broke down again. Right here, you can see it broke down one more time. She went sideways right here. One more time, she started to break down again. She got into this consolidation. When this happens, just tell you there's internals. The internals in the market are breaking down. Internals are breaking down. That's not good. Finally, she broke out, and she moved again. We had another consensus, and you can see it from here all the way up to here. Nice consensus up here. So that, and you can tell that was starting in, it was right around the beginning of May. Okay, that was around the beginning of May. So at that point, if we went and took a look at them, there was a problem. And what was the problem? When you look what was behind this rally, remember the New York Stock Exchange, we already had a problem. 4 times it couldn't break out. And that's because we had more stocks on the New York Stock Exchange going down than up. And then when we took a look at this rally, there was a problem. Because 25% of this move was Apple. 25% of this move was Apple. So it meant if anything happened to Apple, we'd have a real problem. And that's why we started to go sideways again. And now we've been stuck in the sideways market for over 6 months in a range of 4.5%. This is 4.5% between the bottom and the top. So this was a big signal that the market was starting to break down, and it says that they gave us the message here because this tells you when you get this kind of a thing, after you get a consensus and you get this, it tells you the internals are breaking down. And then here it is. Apple had 25% of the action here. You can't have 25% moving the whole market up. Just one stock responsible for 25% of the move. And that's why she started to break down again. So now here we are going sideways. Now, what we're finding is that if you take Apple, and what we said, if something happened to Apple, and let's go take a look. And let me bring out first, so we make sure we got the right dates here. Okay, and if you look, this rally started right here on February 3rd, 2015. So February 3rd, 2015, up to, let's say this area up to the February 25th, we had the market go up about, I don't know, that's probably about, I would say about 20%, something like that. And I'll give it. Let me find out for sure. Let's see. We'll take. Yeah, give me a number here. We went from 200 and we went from 202. 202. Okay, up to about 212. So that was a pretty good run. That was about that was around 5 to 7% run. So 5 to 7% run in the S&P. 25% of that 5 to 7% is one stock, Apple. Now let's go back and take a look at Apple. So let's go back to February 3rd on Apple. Now put up Apple over here. Let's put up Apple. And Apple, if you look at Apple, we have, I'll move it right over here, Apple. You take Apple, we had Apple, it moved from January. Okay, let's take the same run right here now. Let's go from this is Apple, so let's go from here. Let's go from, it started to move up from let's start at $110 to 110 to approximately 133. 110 to 133. So we had a 20% move in Apple. So you got a 20% move in Apple. It's taken up one stock. The market goes up 7%. 25% of the rally was Apple. And Apple itself went up. Inside the 7%, Apple went up, what did we just say, about 20%. That's why we have a problem. That's one of the reasons why we have a problem now. So now the market's been going sideways here. It can't break out. Why? Because this gave us the signal we had a problem. And the Apple, I'm calling this the Apple problem in here. You can't have, that's like having a restaurant and 25% of your sales every night is one big fat guy comes in. And if he eats a chicken and he gets a chicken bone caught in his throat and he dies, you're depending on one guy for 25% of your revenue. So the stock market was depending on one stock. And what happened to Apple, remember, it started to collapse. It started to drop. And that's what happened. So if you look at Apple, I'll put up here again. Okay, Apple started to break down. See how Apple started to break down? And she's been breaking down ever since. See it? So Apple started to break down. Now let's do an overlay. I'll put up SPY. You see what happened? So SPY started to break down and go sideways. But here's the difference. They're holding the stock market up. We call it the steel I-beam pattern. But remember, if we do an overlay on Apple, it almost looks the same as this, but what's Apple doing? Watch. So if we overlay, here's the stock market, but Apple's doing worse. So let's look at it this way here. Apple, let's move Apple out of the market. So Apple is breaking down. So here comes Apple. So they're holding the stock market up while Apple breaks down. Now they're holding the stock market up also when there's another big event that's happening. There's a crossover, what we call the diamonds. And I'll show you what I mean on this chart right here. This chart, if I put up the diamonds, the Dow 30, this is very bad. This is a very bad signal. Right here, let me bring this back. And you see how the yellow line's crossing the white line? That's a death cross. You very seldom ever see that. That means about 30 or half of the Dow 30 stocks have already began to correct. 13 stocks in the Dow, if you go back and look at them now, have already corrected 10%. We're talking about major stocks. We're talking CAT, we're talking Procter & Gamble, United Technologies, Walmart, Intel, American Express, and so on. 13 of the almost half of the Dow 30 is collapsing, and that's when you see that. So that means the other half is going to collapse. So let's go back to the S&P 500. Let's take 500 stocks, and here's your 500. So we got the big stocks collapsing right now, Apple and the rest of them. So they're artificially holding the market up with stock buybacks. And that's why the market can't move. And all the big guys now started in June bailing out. They're bailing out. We're also seeing that we also have oil dropping. We have iron ore dropping. Okay, so you got iron ore dropping, you have gold dropping, you have copper. Let's take copper and oil. Those are the two big ones because that's in construction. That's what China uses all that. So they're not using any of that. So we got a problem in China. That's why they devaluated their yuan last week. And you know they got problems when copper is down and oil is down. And we got all the big institutions pulling out. And you see big stocks like Apple. So let's say 15 stocks, 15. We'll use 13 to be accurate. 13 of the Dow 30 stocks of the 30 are breaking down. So you can see how they're supporting the market, artificially propping this market up with stock buybacks. That's all that's happening. So this market is ready for, as I said to you, starting the last week of June, this market is ready for a 10 to 20% correction. So I hope this helps you understand. And there's another problem. Why I think another reason why I think I'm right. If you take the 200-day moving average, it's a support. If you look at a support on a stock market, we have what we call an average. You don't even have to know what they mean. Just know they're support lines, big support lines. So we got big support lines. I'll show you what it means right here. See this big white line right here? That's a big support line. I'll show you 1 second here. Let's take a year. This big white line is support. That's huge. That's like having a base of steel and iron to support all of this stuff. Say these were all houses, and they're supporting it with steel and iron and so forth. We have now more stocks that have broke below this 200-day moving average. We have more stocks that broke below this 200-day moving average than we had when the stock market crashed in 2008. Yet our market hasn't crashed yet. Why? Because they're holding it up artificially with the steel I-beams. And what's the steel I-beam pattern? Once again, is stock buybacks. So there you have it. We got all the evidence that's in. We got our PE ratios are too high. Our PE ratios on the S&P, about 22. If you go back in all of history, it never got more than 16. If they raise those rates on September 17th, like when we're going to have their announcement, they said they're going to raise rates. You can't raise rates when PE ratios are way out of whack. The market will collapse. That's another reason why you're seeing the big institutions bailing out. Okay, and that's why the market can't go up, because the big institutions are bailing out. So, and you got China in trouble. So if they go and add interest rates, are you kidding me? At the worst time possible, that will be what will ignite the balance of the 13. Remember, we got 13 of the S&P, of the Dow 30. Dow 30 already have corrected 10%. That means the other half, okay, of the Dow 30 will correct. We already have a correction in the emerging markets. Most emerging markets like Brazil and Vietnam and all the other countries, especially the BRIC countries, okay, their markets have already corrected 10%. So you got the emerging markets correcting 10%. You got China's markets collapsed. Everybody's dumping out of the market, but guess what? They're just hoping to keep this market up. So that's why, please join my gang so I can give you the PT2 right here. I can give you the PT2. So when the S&P starts breaking down, all you have to do is be short. Let me show you how simple this will be. Never again will you lose money when the market's going down. It's already turned red. And when this market starts going down, this will tell us. Just like when they had copper. When copper started to drop, see, my PT2 told me in advance right here. It switched from green to red. And that's what, see how it goes from green to red? That's the same thing it's going to do in the S&P. It just turned from green to red. Green to red. So see how all the green to red? So you'll be ready when the market's ready to correct 10, 20%. Be the first time you've ever made money when the market's going down. So please join my gang. You'll be fine this time because you're with me. You'll be fine. See you on the charts.